Imagine sitting in your living room, the house you've lived in for 40 years, watching a friendly celebrity on TV telling you that the government has a special program to let you tap into your home equity without ever having to make a payment. Sounds like a safety net, right? Here's the reality that nobody on those commercials is going to tell you. After 10 years, that same loan could cost you over $100,000 in interest and fees. After 20 years, it could be over $300,000. And if you pass away and your spouse's name isn't on the paperwork, they could get a letter demanding $293,000 or lose the home. Look, I need to say this clearly. This is not financial advice. I am a guy on the internet tracking corporate mechanics, not your certified financial planner. Do your own math. I'm Tom, and this is Tom Thinks. I'm here to cut through the Wall Street jargon and give you the real talk on your money, even if it hurts your feelings a little bit. If you're someone who thinks a lifetime home loan or a reverse mortgage is a safe way to fund retirement, hit subscribe and give this video a thumbs up. The equity trap. Here's the thing about the 70-year home loan. It sounds like a solution, but actually functions as a financial extraction mechanism dressed up as a safety net. The financial services industry has spent billions marketing these products as a way for seniors to age in place and access the wealth they've built. But when you peel back the marketing, what you find is a system designed to strip equity, not preserve it. In the 1990s, fewer than 10,000 reverse mortgages were issued in a year. By 2009, that number had exploded to over 114,000 loans in a single year. Why the explosion? Because the system set it up to look like the only option. As pensions evaporated, and look at this number, in 1983, 62% of private sector workers had a defined benefit pension by 2010. That dropped to just 19%. Seniors were left with Social Security checks that weren't keeping up with costs. So the financial industry stepped in with a solution. Here's what most people don't realize. The average reverse mortgage borrower is now under age 70. They're taking these loans earlier, which means the equity drain has more time to compound. And when you take out a lump sum, which 70% of borrowers do, you're twice as likely to default on taxes and insurance compared to someone who takes a smaller draw. The system doesn't just allow this, it's engineered for it. The upfront costs alone can range from $8,000 to $13,000 on a $250,000 home. That's before a single dollar of loan proceeds hits your pocket. This isn't a safety net, this is a wealth transfer from the elderly to the financial sector disguised as compassion. How we got here. To understand how we ended up with a 70-year home loan product that destroys more wealth than it creates, you have to go back to the fundamental shift in American retirement. We moved from a system where corporations and the government shared the burden of retirement funding to a system where the individual carries all the risk. That shift happened over about 30 years. When pensions covered over 60% of workers, people could retire with predictable income. But once those pensions disappeared and were replaced by 401k plans, the risk of market downturns, inflation, and longevity all landed on the individual. Now layer on top of that the housing bubble and crash of 2008, home values dropped and suddenly millions of people approaching retirement saw their net worth cut in half. Enter the reverse mortgage industry, which swooped in promising to unlock the one asset that still had value, the home. But here's the historical irony. The same federal government that backs these loans through the Federal Housing Administration has had to bail out the program. In fiscal year 2012, the reverse mortgage program lowered the value of the FHA's insurance fund by over $5 billion. The Treasury had to transfer $1.7 billion to keep the fund solvent, the first time in history that it happened. So the taxpayer subsidizes a product that drains equity from seniors, and then the taxpayer pays again when the program losses pile up. That's not a safety net, that's a subsidy for financial extraction. Meanwhile, the number of affordable homes has cratered. In 1970, America had a surplus of 300,000 affordable homes. Today, there are only 37 affordable homes available for every 100 extremely low-income renters. The system is designed to create scarcity, then sell you an expensive loan to cope with it. Hidden extraction mechanics. Now let's get into the actual mechanics of how these loans extract wealth, because the complexity is the feature, not the bug. A reverse mortgage sounds simple. You get money, you don't make payments, the loan gets paid when you leave the house. But look at the fee structure. There's an initial mortgage insurance premium of up to 2.5% of the appraised value. There's an origination fee that can go up to $6,000. There are closing costs between $1,500 and $2,500. There's a monthly servicing fee of $30 to $35 that over 10 years adds up to $3,600, and over 20 years it's $7,200. And then there's the monthly mortgage insurance premium of 1.25% of the loan balance, which compounds. Take a concrete example. A 68-year-old borrower with a $250,000 home who takes a lump sum of $135,000 at 4.99% interest. After 10 years, the loan balance grows to over $250,000. After 20 years, it's over $450,000. The equity doesn't just decrease, it gets consumed by the loan. And here's the psychological trap. Because you don't make monthly payments, the cost feels invisible. You never see the money leaving your account, so you don't feel the pain of the extraction. But it's happening every single month through compounding interest and fees. This is the same playbook used by slumlord empires. Look at the recent RICO lawsuit against the Rajoyan slumlord empire in Washington, D.C. They acquired over 70 rent-controlled buildings, defrauded lenders with fake renovation promises, collected over $16 million in government housing subsidies while letting properties rot, and used the proceeds to buy more buildings. The mechanism is the same. Complex structures, misleading promises, and extraction disguised as help. One system targets vulnerable tenants, the other targets vulnerable seniors. Both rely on the fact that the victim doesn't fully understand the financial mechanics until it's too late. Flipping the script. Now you might be thinking, Tom, if these loans are so bad, what's the alternative for someone who needs cash from their home? That's the right question, but here's where we need to zoom out and look at how the wealthy actually use real estate in retirement. The affluent don't typically use reverse mortgages. Instead, they utilize a different set of strategies that preserve equity while generating income. One approach involves the strategic use of portfolio assets to cover expenses rather than converting home equity into debt. Another involves utilizing investment income streams from diversified holdings to avoid tapping the home at all. The core principle is this: the wealthy treat the home as an appreciating asset to be preserved, not as an ATM to be drained. Now, there's also the option of selling and downsizing, which many financial models show as superior to reverse mortgages in preserving net worth. The strategy relies on moving from a high-cost, high-equity property into a lower-cost asset, freeing up cash that can be invested. Historically, investors utilize index funds and income-producing assets to outpace inflation, rather than paying compounding interest on a reverse mortgage. Another tool in the toolbox is a traditional home equity line of credit, which has much lower upfront costs than a reverse mortgage and can be drawn on as needed. The difference is that a HELOC doesn't have the massive upfront insurance premiums and monthly servicing fees that erode equity. The key insight is that any financial product that has exceptionally high upfront costs and complex compounding fee structures is usually designed to benefit the issuer, not the user. The wealthy know this, which is why they avoid these products. They analyze the total cost of capital rather than looking at the monthly cash flow in isolation. Building the alternative. Let's walk through the analytical framework for making this decision without telling you what to do specifically. First, the math. Calculate the total cost of a reverse mortgage over the expected time in the home. For a $250,000 home with a $135,000 lump sum at 5%, the cost after 20 years is over $300,000 in interest and fees alone. That means the total repayment could exceed $450,000 on a $135,000 loan. Now compare that to the alternative strategy of selling the home, downsizing to a $75,000 property in a lower-cost area, and investing the remaining $175,000. At a conservative 6% annual return, that $75,000 difference grows to over $240,000 in 20 years. You've not only preserved your equity, you've grown it. The second analytical piece involves understanding the tax implications. Reverse mortgage proceeds are not taxable, but neither are the proceeds from selling your primary residence up to $250,000 for an individual or $500,000 for a couple. So the tax advantage claim is mostly marketing fluff. Third, consider the liquidity aspect. A reverse mortgage gives you cash but consumes your equity. A downsizing strategy gives you cash plus a portfolio that remains liquid and can be rebalanced. The analysis shows that for most people, the reverse mortgage is the mathematically inferior option when you run the full life cycle cost. The wealthy don't look at monthly payments in isolation. They look at net worth impact over time, And when you run those numbers, the reverse mortgage almost always comes out behind. This is why the smartest investors I know treat their home as a store of value and a hedge against inflation, not as a checking account to be drained through expensive financial products. Your financial wake-up. Here's where I want you to take action. Not by running out and making a financial move, but by doing something more important, changing how you think about home equity and retirement. I want you to drop a comment below and tell me, have you or someone you know been offered a reverse mortgage? What was the sales pitch? Was it the celebrity endorsement, the government benefit implication, the you can't lose your home promise? Because I want to hear those stories. This is how we collectively wake up to the mechanics of the system. Share this video with someone who is approaching retirement age or has parents who are. Send it to anyone you know who might be considering one of these 70-year loan traps. The more people who understand the actual fee structures and compounding costs, the harder it is for predatory lenders to operate. Now, let's close with a philosophical thought. The system is rigged to make you think that borrowing against your future is the only path to comfort. But every time you sign a complex financial product with high upfront fees and invisible compounding costs, you are transferring your wealth to someone else. The real secret to winning this game isn't a better loan, it's understanding that the loan itself is the trap. The wealthy don't borrow against their appreciating assets, they own them free and clear, and let the appreciation compound uninterrupted. They treat liquidity as a tool, not a crutch, and they never ever sign a contract where the fees are more complicated than the benefits. You don't need a financial product to save you. You need a framework for thinking about money that puts you on the side of the house, not the side of the casino. Go look at your balance sheet with fresh eyes. Your future self will thank you.
Found this interesting? Subscribe to the channel. Give this video a like, share it out, and drop your questions or ideas in the comments. Until our next adventure.